Welcome to Market Catalyst. I'm Julie Hyman. We are 30 minutes into the U.S. trading day, and here's what we're watching today. First, we'll discuss the state of the U.S. consumer as retail sales data shows no growth for the holiday season. Plus, we'll bring you the top takeaways from CVS earnings after I caught up with the company's chief financial officer. And we'll discuss the future of streaming as Spotify posts record user growth, and we'll also look at the artists poised for success in 2026. All that and more coming up on Market Catalyst. But let's dive right into what's going on in the markets today. What we have is a little bit of a modest gain in the market. So right now the Dow is trading higher by about 350 points or so. The S&P 500 is attempting to make a new record. It's up just about 1/5%. The Nasdaq is a little change. Getting back to the S&P 500 for a moment and that push towards a record. I'm just going to put up a 5-day chart here. So we're not quite at that level, but we're watching a potential record close here today. So that's something if we see an extension of the gains. Obviously, we had the sell-off last week and then followed by a few days of gains. In terms of how that's translating into the sectors that are on the move, consumer discretionary, the best performing group today, a bit ironic considering that retail sales report came in with no change versus 0.4% increase expected for December. So holiday spending, the read-through is maybe looked a little bit more tepid at that point than had been anticipated. Utilities gaining as well. Energy, which has been the big winner on the year, is down today. And looking at what's going on in large cap tech, we see an interesting trade there. Now, Google, as we know, Alphabet just rolled out a 100-year bond sale in all kinds of different currencies. And we are seeing the shares actually under a little bit of pressure after that. As we know, Alphabet's planning to spend $200 billion on CapEx this year. Elsewhere within large cap tech, it is a little bit more mixed. But I want to go back over here and take a look at some of the trending tickers today because it's interesting the earnings movers that we have been watching today. We're going to dig more into some of these in a moment. Spotify, for example, which is up almost 17%, its best gain in about a year on the back of its strong subscriber numbers and margins. We're going to dig more into this with an analyst a little bit later on. Coca-Cola down a little bit more than 1% after it came out with a forecast, the lower end of which was disappointing to analysts. S&P Global, the big data and index company, those shares down 8% after a disappointing forecast, and it's pulling down shares of other kinds of market data providers, FactSet and MSCI, for example, Moody's as well. We'll get into some of the other movers as the day goes on, but as we have reminded you before, when it's earnings season, you get a lot of these big individual swings, even if on the index level, we are not always seeing as much change as when you're looking at a relatively minor gain in the S&P 500. Well, earlier this morning, we got retail sales data for December. The Census Bureau saying sales were flat year over year. In recent quarters, we've heard CEOs and CFOs say consumers are more choiceful, cutting back, focusing more on essentials. We've also heard a lot about the so-called K-shaped economy. That's where a larger share of total spending is driven by the wealthiest Americans. So we want to take a closer look at the state of the U.S. consumer. And joining me now, Furman, PwC US Consumer Markets Industry Leader, and Yahoo Finance Senior Reporter, Brooke DiPalma, who focuses in, zeroes in on all things consumer for us. Thank you both for being here very much. I got to start on these retail sales. And I've seen some speculation, sales, promotions by retailers keep coming earlier and earlier. So maybe people spend all the money in November, and then they were done with all their holiday shopping by December. Is that a realistic way to think about it? What do you think?
I think that the data coming in this morning is very interesting. When we look at year over year data, what we're seeing is actually a stronger than expected holiday season. Holiday spend was up 6.4% year over year across all generations, and that includes all payment types. So we're talking credit card, debit, buy now, pay later, even SNAP is included in our numbers. So when you break that down to your point about K-curve economy, it does validate that we are in a K-curve economy. The high income cohort, 125K household income or higher, spent 29% more on holiday year over year, where the mid and low income cohorts actually pulled back about 4%. And their share also changed. It went down about 2 to 5%, and the high income share increased, share of total holiday spend, by about 7%. So we do see that divergence. So although it's a story about growth year over year, there's certainly a bifurcation between income cohorts. And to your point, we know the low and middle income cohort are spending more of their wallets on essentials, cost of living expenses, leaving less left over for holiday.
I mean, and this is what we've been hearing from companies also. I mean, we were talking earlier about Coca-Cola, and all of these consumer products retailers that are trying to tweak their offerings, tweak their pricing, figure out what the sweet spot is that keeps people buying their products, but at the same time doesn't like wither away their margins.
Yeah, and what we were talking about was this key lingo word within the industry was price pack architecture, where everyone's trying to switch around just how many cans are included within the Coca-Cola pack. And that's what we heard from Coca-Cola's CEO when I was on the phone with him this morning. He ultimately said that they're playing into this, that the low-income consumer is playing into value, even going to more dollar stores in order to get the best bang for their buck. But as we've heard from many different C-suite executives, is that the K-shaped economy is continuing, and also value is super important. Take a listen to what people have been telling us so far this season.
60% of our consumers' average household income is over $100,000 a year, and they're still spending in this tough economy.
The middle, lower income consumer, quite stable, same as last quarter, but still very stretched in their budgets, trying to be choiceful and cautious on how they spend their money.
1 out of 3 units now that we move are everyday essentials. And what we find there is that the more the customers can rely on us for everyday essentials and the lower ASP items, they just choose to do more of their downstream shopping with us.
And what's so interesting is just consumers really focusing in on essentials, as you noted, but also these companies trying to tackle, okay, we have higher costs, higher prices, maybe because of those tariffs that are finally going through, and we want consumers to ultimately buy more still in this environment where they're still choiceful and cautious, or like the words we've been hearing over and over again.
Well, I guess the question is, Allie, what's going to change this?
Right.
Oh, that's a great question. So what could ease this K-curve economy?
Yeah.
So a few things, right? We could see inflation that's been pretty persistent subside a bit. That could help. The housing market could improve. We did see some slight improvement in the back half of calendar 25. If that continues or improves further, that could help. We also are seeing this disconnect between GDP growth and GDP projected growth and wage growth.
Right.
If that gap closes, that could also improve, right? We're not seeing super high unemployment, but we're seeing higher than usual underemployment. So people that have part-time jobs are having trouble getting full-time jobs, and people that don't yet have jobs, it's a little harder in this environment to get a job. And a lot of those are younger generations of consumers under 30, and that's our future consumer. So if that improves, which it might, because you have disruptions out there like weight loss drugs, I talk about that all the time, right? New brands, new products, new industries could be created through this physiological disruption, we could see improvement.
I was looking at some of the figures around wage growth versus consumer inflation, headline consumer inflation, and wage growth over the past couple of years has actually come back and is outpacing inflation. There you see what happened sort of post-pandemic. But I think a couple of things are going on. One, the perception is still that inflation is hot, and it is hot in certain items. And secondly, the overall price increase, the total price increase, is still eating into the share of spend on various items, right? So, I mean, maybe it's not just, I guess what I'm saying is it's not just that inflation has to ease, like something more fundamental, it seems, has to change perhaps with psyche.
We saw PepsiCo lower prices, right?
Oh yeah, we did. But then we see a company like Hershey, kind of ride along with inflation and have a lot of success. But they're also shifting their portfolio significantly towards more snacks that correlate to wellness, right? They're riding that trend.
Like popcorn?
Yeah, exactly. Pirate Booty is one of them. Necessary Evil they recently acquired. So
that's a good one.
Dots pretzels, right? So some of those are performing really well in the current environment.
And they don't include cocoa, which has been so inflationary, which has been pushing up the prices.
Right.
Exactly.
Yeah.
I mean, the other thing that you have to really focus in on is we are still seeing a resilient consumer. There is a significant say versus do gap, particularly these younger generations. I mean, when we first surveyed in the summer about holiday, Gen Z told us they were going to pull back 23%. Well, fast forward to the actuals, they spent 21% more year over year, right? So to your point, there's a perception out there that everything, prices are high and inflation has a significant impact, but then what consumers actually do is often very different than the sentiment.
And what was so interesting too on that same younger consumer was that Chipotle CEO actually said on the call that 18 to 24-year-olds has been pulling back, and this quarter they gamified the process, gamified the ability on their app, sort of making freebies and getting different rewards by doing different things, and that brought back in that younger generation. So it's all about like trying to get that consumer where they're at and what they want to engage with the brand.
I'm also curious what money they're spending. In other words, do they have this cash? Are they using buy now, pay later? Are they using credit cards? Because if they're not,
like,
because if they're not getting jobs at the rate that they want, are mom and dad who are invested in the stock market helping fund some of this?
Yeah. I could speak to this a little bit. So a few interesting points. Number one, credit card delinquency rates of people 30 and under are about 10%. The national average is 3%. So we do see this generation having higher credit card delinquency than other generations. Number two, this is a Gen Z in particular. They're a paradoxical generation. They're the most cost conscious we've ever seen any generation be, but yet they're willing to splurge on things that provide joy, give them social status, speak to self-improvement, and they also splurge on experiences. So, they have some money and they're willing to spend it on those types of things. The other point, they only made up about 5.6% of total holiday spend share, whereas a generation like baby boomers made up, 34% of share, just to, give you some dimensionalization there. But, so they don't have a ton of purchasing power now. Their average age is 22. By 2030, they're expected to have $2 trillion in purchasing power in the US, $12 trillion globally. Where is that coming from? Well, they're going to grow up and they're going to make more money. But also, there's expected to be a significant transfer of generational wealth to this generation,
Sure.
right?
Yeah, that makes sense.
And also what's so interesting that I've been following is the effects of this one big beautiful tax bill that's coming out and the implications that could have for stimulus into the economy. Bank of America predicting that this will be a $135 to $140 billion of consumer stimulus around tax season. And so what are the implications there? They think that middle and higher income households are going to benefit more, but McDonald's sort of hoping on the fact that the lower income consumer will also benefit as well.
Well, but that also speaks to the point about how lumpy this spending cycle is. I was just reading some research from Tom Simons over at Jefferies. He's an economist there, and he was reacting to the retail sales report and said, particularly the lower income consumer needs those events, right? Whether it be holiday or back to school or tax return season, to sort of get them out there and spending a little bit. So, we'll see what that looks like across the income cohort when people start getting their refunds.
We're seeing that in the data as well around what I would call either holidays or cultural moments. It's a similar thread from Halloween to Super Bowl to Valentine's Day. Increased spending year over year due to increased participation. So these holidays are becoming more inclusive. For Valentine's Day, people are gifting not just their romantic partners or romantic interests, but their pets, their children, a chosen family,
game.
Right? So we expect participation to go from 52 to 55% year over year. Super Bowl was a significant increase in who participated, and women they did most of the buying of Super Bowl related snacks and party items.
Yeah, I also heard televisions did really well. Television purchases around the Super Bowl. You wanted a bigger
That makes
TV.
sense.
Yeah.
That makes
Watch
sense.
the big game.
Guys, before you go, I want to bring up a news item from today. And Allie, feel free to weigh in or not on this one.
Oh boy.
Eddie Bauer. We're talking about consumer. Eddie Bauer, what I think of as a pretty iconic consumer brand, has filed for Chapter 11 bankruptcy, the outdoor gear brand. This is actually the third time it's filed. It filed back in 2003 and 2008. It was founded in the 1920s by a guy named Eddie Bauer. There was actually an Eddie Bauer. But, it just seems like after everybody during the pandemic was buying outdoor gear because they didn't have anywhere else to go except outside.
Yeah.
And so they did really well. And then that demand kind of dried up to some degree.
Yeah, and what I would say on this is not the first time that we've seen a retailer file for bankruptcy this year.
Sure.
We saw Saks Global also file for bankruptcy earlier this year. And what the company ultimately said, is that there's these changes that are happening so fast within the category, not just within like the outdoor market as so many other competitors come in, but also just generally consumers are thinking differently about where they're shopping, when they're shopping, and how they're shopping, and how much they want to spend. That would be my take on it. I don't know if Allie is thinking differently.
I'll just add that we are seeing winners and losers in this environment. You mentioned dollar stores, big box stores. We have a very value conscious consumer right now. right? We're seeing high-end consumers trading down. We're seeing low and middle income consumers looking for deals. Price for value has to match in this current environment. And then you can't discount the influence of these younger generations, Gen Z and Gen Alpha, right? They're the future consumers with purchasing power, but they're having an outsized influence on what all other generations are seeing because of how much time they spend online. 90% of their free time is spent online. So they are literally cultural early warning systems.
I believe that. Think about social
trends.
media, everything, TikTok.
I know.
How much time people are scrolling these days.
I'm praying for a backlash. That's all I gotta say against that.
I mean, they're probably going to Aloe, let's be real, instead of Eddie Bauer these days.
Yes, that is probably true. And I think of Eddie Bauer as sort of mid-range cost-wise, right? And so maybe...
Yeah, I would wonder who some of their competitors are. Is it like
LLB,
Atlas,
Land's
LLB?
End, that's what I would think of for them. REI maybe also. That's how I think
Could we
of
see this
Eddie
pop
Bauer.
up maybe in a different form? Because they are closing all locations from what I
If
understand.
they don't sell them. If there are about 220 locations in the US and Canada. If they don't sell all or part of those, they'll close. And they apparently, according to the Seattle Times, are closing their headquarters and laying off 60 folks as part of that. They're owned, by the way, the parent company called Catalyst Brands, which owns a bunch of other consumer brands.
JCPenney's.
And those are not part of this. It's just Eddie Bauer that's part of this.
Yeah.
So
We didn't see.
I guess you'll have to get your
Hiking boots somewhere
hiking
else.
boots and your I don't know, your coats, your sleeping bags.
Coats and hats.
Hats,
It's cold here.
exactly. It is very
Yeah.
cold. We need to get them somewhere. All right, Brooke, Allie, thank you so much. Appreciate it. Coming up, this year's M&A outlook for the biotech sector. You're watching Market Catalysts. Deal making in the biotech industry is set to accelerate in 2026. Biopharma company Halozyme, no exception. It spent up to $1.3 billion acquiring biotech startups over the last 3 months. The company specializes in drug delivery, partnering with the likes of Johnson & Johnson and Bristol Myers Squibb in improving the way medicine is administered. I want to bring in the company's CEO, Helen Torley, now to talk more about this trend that we have seen within biotech. Helen, thank you so much for being here.
Appreciate this opportunity.
So we have been talking a lot about how the conditions are prime for an M&A wave broadly this year. And I know specifically in biotech, that's a big topic of discussion as well. What do you see as the sort of conditions that are improving or opening the door for, and you've been doing deals already, but what might make it even a better environment this year?
Yeah, I think over the last 2 years, people have been more stalled in terms of making decisions and investments throughout the biotech industry. I think recent good launches, positive factors in terms of uptakes of drugs are just giving companies more confidence in the ability to be able to identify and launch more drugs successfully. I think there's also a lot more clarity with regard to some of the administration's changes that is still supporting that innovative drugs will be reimbursed and used by patients. And so that really is what led Halozyme in the fourth quarter to complete 2 acquisitions to extend our leadership in subcutaneous drug delivery. And just to say a word in that, Julie, just to introduce Halozyme to the viewers, we are the pioneer of rapid, large volume subcutaneous drug delivery. Many people, and Julie, you may also have somebody, a family friend who's had cancer, has had to go to an infusion suite and sit there all day getting their treatment into a vein. With our current technologies, we can deliver those medicines in just minutes in a simple jab under the skin. Now that can be given in the doctor's office, or it can also be given in the patient's home. And that's with our enhanced technology that's got 10 approvals today and is generating $1 billion in royalty revenues in 2026. But what we are very excited with the 2 acquisitions is to acquire a hyperconcentration technology from Electrify and Surf Bio that will allow us to further advance care for patients by allowing drugs to be concentrated into an even smaller volume, where they might even be able to be given at home by the patient or by the healthcare professional in a single short injection in seconds. And you can imagine that's going to transform the experience for the patient, for the caregivers, but importantly, reduce stress in the healthcare system by reducing costs and nursing time and free up care for people who need it. So we're very excited for this evolution in patient treatment that we're able to bring forward with subcutaneous drug delivery.
Helen, indeed, I have known people who have had to go to those infusion centers. So the less time that people spend in those the better, if it indeed is the way forward. I want to ask a little bit more about some of the changes we have seen to funding of biotech and pharmaceutical research, because we've seen obviously some pretty dramatic cutbacks over the past year under this administration. And so I wonder what that does to the pipeline for a company like yours, if maybe it increases the chances of M&A, or that there's more need for sort of corporate funding of that kind of research as the government has stepped back.
Yeah, I would say as we look at 23 and 24, there definitely did seem to be a little bit of a contraction in terms of the development that pharmaceutical companies were doing, and it was harder for biotechs to get money to perhaps develop as broad a portfolio as they wanted. But certainly second half of 2025, we saw more money available for those companies to be investing and developing their own drugs. Pharma is certainly very interested in acquiring late stage to expand their portfolios to address some of the patent cliffs that are coming up for them. And so it is a very good time in our industry for M&A, but very importantly for patients. There are more and more drugs that are now in development, and we're very excited to have the opportunity to be bringing our technologies to those companies. Indeed, in the fourth quarter, we signed deals to make subcutaneous versions of drugs for obesity, for inflammatory bowel disease, and also for a special type of lung cancer. And so companies are investing. It's a great time in the pharmaceutical and biotech industry. We're definitely seeing just an unleashing, I think, of innovation and great interest in making care even more patient-centric than perhaps it was in the past.
What do you think are the characteristics of companies that are potential acquisition targets, both by you and just more broadly in the industry?
Yeah, the data would suggest that there definitely is a bias towards the companies that have gone through the initial de-risking. So perhaps they have gotten into strong phase 2 data, which is the second test that companies do to make sure they've picked the right dose, and are beginning to see the safety and efficacy profile of the drug. Or even some companies wait for the full de-risking, which happens at the end of the true test, which is called a phase 3 study that really looks to statistically prove that the drug is working and has a good risk benefit for patients. So a bias towards that de-risking is definitely something the data I was looking at recently was suggesting, and perhaps less on the early stuff that hasn't been de-risked. For Halozyme, the two companies we bought are earlier stage. But what's great is because Halozyme has had such a track record of success in the last 10 years of advancing the first subcutaneous technology that was available for large volume delivery, we're able to apply our expertise to help accelerate the time of development for the Electrify technology and the Surf biotechnology. Indeed, the Electrify technology we expect to be in the clinic with 2 tests by the end of this year, and for this to be a new in hands by the mid-2035s, with that $1 billion goal out there by the mid-35s based on the royalties we expect to receive on developing a number of drugs in this simple shot. And I have an example here of the future. We believe for care for cancer, for kidney disease, for autoimmune disease. Imagine instead of those infusion suites I started with, patients are getting their treatment by simply twisting off the cap and then pressing it into their skin. Goes in seconds. That's what we're hoping this hyperconcentration technologies from Surf Bio and from Electrify is going to be able to enable in the next 5 years or so.
Helen, thanks so much for your time. Appreciate it.
Thank you.
Coming up, the biggest takeaways from CVS earnings after my conversation with the CFO. Stay tuned. You're watching Market Catalysts. CVS shares are rising, up a little more than 2% after the company reiterated its profit guidance for 2026 and posted strong fourth quarter performance. Now, I had a conversation with the company's chief financial officer, Brian Newman, on the phone, and the company's forecast for the full year is $7 to $7.20. $7.17 is what analysts have been predicting. And initially, we saw the shares pull back a little bit before this recovery that we have now been seeing. He gave a little bit of color on that forecast, and he basically says his priority is to give guidance that's credible and clear with opportunity for outperformance. And so perhaps there's a little bit of upside that some analysts are now expecting and baking into that. The company also changed its cash forecast for this full year to $9 billion. He says that has to do with the timing of some government payments. I also wanted to talk a little bit about the three main business lines for CVS, because it is such an enormous company and does have a lot of different business lines. So there's the healthcare benefits. That includes Aetna, the insurance company. Revenue there rose by 10% to about $36 billion. Health Services, which is their pharmacy benefit manager, CVS Caremark, and Oak Street, which is a medical provider. Revenue there rose by 9% to just about $51 billion. And then pharmacy and consumer wellness, and that includes the CVS pharmacies that you go into. That revenue was up 12.4%. And that is really an area of the company that has seen a comeback. They've been investing in employees and staffing. They've been investing in technology. And they also, of course, bought some Rite Aid prescriptions that they transferred over to CVS. So that all has helped the numbers. One of the big questions hanging over the company now is what's going to happen with Medicare Advantage, which has been a driver of that insurance, that business in the Aetna and in the health insurance division, because as you know, and as we've reported, Medicare Advantage, the reimbursement rates for 2027 were just announced, and they weren't as high as basically anyone had expected. So I asked Brian Newman about that and what the company planned to do about it. And he said, I don't think it reflects medical cost trends. I think we're hoping CMS, the Center for Medicare Services, will address some of the misalignment. And we are already submitting our comments to CMS to hopefully improve the policies and how they think about that. Now, it's not a done deal, this 2027 rate increase. CMS is scheduled to publish another update in April, potentially taking into effect not just CVS's objections, but the industry more broadly. So we'll see if that ends up being any kind of change. But that's been an overhang on CVS and any other insurer that is exposed to Medicare Advantage. So watch this space. Meanwhile, 2026 shaping up to be a strong year for the IPO market as investors wait for potential debuts from big names like SpaceX and OpenAI. Yahoo Finance's Josh Lipton spoke to Gene Tier, senior data engineer at Crunchbase News, about the state of the market.
I'm curious, Janae, just to get your thoughts on what we saw in 2025, because you do know, listen, we saw a pickup there last year, and I'm just curious, Janae, what did you chalk that up to in 2025? Was that rates, valuations, market confidence? What do you think?
Hey, Josh, great to be here. So I think 2025 was up significantly in global venture. So it was up globally 30% year over year. And if you just look at the US and North American market, it was up 46%. And we looked under our data and all of that growth was AI related. So I think the fact that so much money was invested last year compared to, I think it was the second highest year for North American venture funding after 2021 when everything was up and to the right. And so massive growth year. And I think that was all to do with AI. And it ties into what we're seeing in the public markets is there's so much excitement around how AI is going to reformat software, how it's changing the whole landscape. We're seeing some of these companies come through who are beginning to get significant market share in these very new sectors. And so I think on the venture side, there's excitement about these new AI native companies who are growing. Then there's the whole infrastructure space. There's deep tech is being reformatted, healthcare. So I think just huge enthusiasm and excitement that we're seeing from investors. A lot of anxiety as well, because it's become way more competitive. But the market is just primed for, there are new companies going to come through who are going to be the leading companies 5 and 10 years from now. And that's why we've seen a massive pickup in venture funding on the private market side.
So given all that excitement about AI, Gene, when you're thinking through the 2026 IPO market, do you think, at the end of the day, Gene, it's going to be even stronger than 2025? And what are the puts and takes? What are the variables that depends on?
Yeah, I do think it is going to be stronger in 2026 and 2025. Everyone, we expect that the biggest IPO, venture-backed IPO of all time will happen in 2026. The last one was Facebook, is the largest of all time at $104 billion in 2012. So that's more than a decade ago. But I think when you're looking at, we have a unicorn board with 1,600 companies valued above $1 billion. The board went up in the last year in more than $2 trillion. You have SpaceX now valued at $800 billion. You have OpenAI second at $500 billion. Some massive, massive valuation increases that we've seen on the private side. And I think so many of those companies have been reading over the last 3 years have been a much slower. 2025, we did see IPOs pick up a little bit, and I think it was really gearing up to 2026. So even though the markets have been quite unstable, there is this concern around how SaaS is being transformed by AI. Nonetheless, there are a lot of companies who have significant revenue, and some are seeing some reacceleration with this AI story, as SpaceX would be one of those. And so I think we are going to have probably more towards the latter half of 2026, we are going to see a pickup in the IPO markets this year, despite all the turbulence we saw in the last week.
If you saw a mega IPO like that, Janae, this year, let's say Elon Musk really did bring SpaceX public, what would that mean for the broader IPO market? Or does it mean anything, Janae? Or is, on the other hand, is SpaceX just sort of, it's a kind of one-of-one company?
Yeah, I think SpaceX is a one-of-one that they could go out in any market. They have revenue in the billions. They're profitable. Starlink is their most profitable product. They've now merged and brought xAI on board, which is obviously going to be a growing concern as well in competing with OpenAI, Anthropic, and Gemini. So I think SpaceX is one of a kind, but I think what the market is looking for is one of those very high-value companies to go out, and that will, in a sense, create some energy and enthusiasm around the market, but I don't think it changes the overall picture. And we're seeing this on the private market side where it's highly competitive. Who are the companies that are leading today? Their revenue is no longer baked in that they're going to be the leading companies in 5 to 10 years. I think there's lots of questions around all those SaaS companies. And so even though SpaceX can go out and there will be excitement, I think there are a number of others. Databricks would be another one. I still think the market is going to look at companies very differently. And, I looked at the Bessemer Venture Index looking at companies growing in the cloud space, and, growth rates are not very high across the board. So even there, though there is this AI story, a lot of these companies have not necessarily seen this reacceleration. And will they, or will they be taken over by other private companies, I guess is the question. And so that's, I think, being factored in.
I'm interested, Janae, do you think if you're going to bring a company public in 2026, do you think you almost have to have an AI story, Janae, an AI narrative to tell public market investors?
Absolutely. I think every single company has to have an AI story that wants to go public. And if you don't have if AI doesn't impact your business, that's what you need to explain. So I think AI is at the center of almost every company that we're seeing go out. And if it isn't, you have to explain why the AI markets are not going to impact your business. And, even if you look at like Figma and Klarna, CoreWeave, AI, it's a data center company. They went public last year and their stock is up massively. But if you look at the other major stocks that went public last year, Figma, Klarna, they're not up above their IPO price. So I think this uncertainty is getting baked into, the newer offerings that are coming out as well. Can they address this? And I think the market's very uncertain. It doesn't know how to price these companies. It doesn't know what these companies' futures look like as this new wave is brought in. And so I think there's a lot of uncertainty on the public side, and we're seeing that on the private side. It's hyper competitive. So even though investors are putting more money to work, they are so concerned about missing out on the next thing that they're putting a lot more money to work, but they're always looking around the corner for companies who are going to come in and compete with their fast-growing startups. So highly competitive.
Finally,
Janae,
you've been watching this space a long time, I know, and studying it. I'm just curious if you think there's, a mistake or common mistakes that public market investors make, Janae, when it comes to IPOs, whether it's, maybe not doing enough due diligence on the fundamentals or getting carried away by hype and headlines. Any takeaways there, Janae?
I think we're in a much more cautious, IPO market. In 2021, there were so many companies that went public that then had to delist and couldn't sustain. So I think the market is much more rational today than it was in the 2021 environment. And I think what investors are looking for is large revenues. I think that's part of it, growth, but also a path to profitability. So I think we're in a much more rational market. than we were in 2021. I think the challenge still is, if you're growing today at 30% or 40% or 50%, is that growth going to sustain itself, or are other competitors going to come in? And so I think the uncertainty is around, can we rely on these leading companies continue to lead in the markets that they're in? And I think that's up for question.
Janae, great to have you on the show today. Thank you.
Marriott missing fourth quarter earnings expectations. The company taking a bit of a hit as airport delays caused by last year's government shutdown affected business travel in particular. Still, fourth quarter revenue was boosted by international travel and strength in luxury. Joining me now, Anthony Capuano, Marriott International CEO and Yahoo Finance Executive Editor Brian Sozzi is with me as well. Anthony, thank you so much for being here. Maybe you can give us sort of a high level, I just gave a little bit on the puts and takes during the quarter, but maybe you could give us a little more color on and how you saw that unfold as the quarter did.
Yeah, of course. Thanks for having me. I think the big headline for me is we continue to see extraordinary demand for travel and experiences. We've been talking about this for the last number of quarters, that it feels like a fundamentally permanent shift, that consumers are prioritizing spending on travel and experiences versus purchase of hard goods. And that phenomenon is really revealing itself in our results. To be sure, the international markets are performing a bit better than domestic. Domestic also had, in the fourth quarter, a little bit of a hit from the government shutdown. But we saw the top end of our guidance range on RevPAR for the fourth quarter and the year. We're guiding to similar RevPAR growth for 2026. And on the growth side of our business, we saw record signings and reported a record pipeline. So the business seems to be firing on all cylinders, and we're seeing particular strength in the luxury end of our business.
Anthony, always good to see you here. Thanks for hopping on after that earnings call.
Nice to see you, Brian.
Likewise. Let's just stay on that high end versus low end. So revenue per available room for Ritz-Carlton, check done, crushed it. You look at Sheraton, a little bit weaker here. We're showing that on the screen right now. Within your guidance for this year, do you see the low end consumer coming back and getting back into the likes of a Sheraton?
Yeah, I mean, there is certainly, pick your description, K-shaped economy, bifurcation of the consumer. We continue to see really consistent strength across luxury. For the full year globally, we saw 6% RevPAR across our luxury portfolio, which represents about 10% of our global room supply. Just under 3 years ago, we entered the mid-scale tier for the first time. We've got hundreds of hotels open and in the pipeline. And even with that lower income consumer, they are still prioritizing spending on travel and experiences, just in a more economical way. And so I think the timing of our entry into that tier really is working out well for us.
Anthony, you're coming up against what could be a real big moment for Marriott this year, and that's the renegotiation of these credit card fees. You teased a little bit of it in the earnings call, but with these renegotiations, how much more profit will you get as these are renegotiated this year?
Yeah, so there's really two dynamics at play, Brian. The first one we talked about in detail today, and that is we have worked really hard over the last number of years to preserve both the financial strength and stability of the Bonvoy program, but also to make sure we preserve the value proposition for our 271 million members. You combine those two efforts with a recent renegotiation we did of a contract, that's allowed us to increase the royalty percentage of economics that we take into the Marriott P&L. And that's what we talked about at length on the call. Then we talked as well, we are deep into negotiations on renewals of our two important branded credit card relationships with JP Morgan Chase and American Express. We expect to have those done later this year, and that should provide some additional upside, albeit on the base of a credit card program that's the largest in the industry by a pretty wide margin.
And I'm curious, when you look at the cohort of people who hold the credit cards but also are part of the Bonvoy program, I'm sure you have quite a lot of visibility as to who those folks are. How's that split look in terms of the income spectrum and also the age spectrum? And are those folks then the ones who are spending the most at your hotels?
Yeah, so I think the profile of the credit card holder and the Bonvoy membership more broadly is very diverse. It's very diverse geographically, it's very diverse from an age perspective, and it's very diverse from an economic perspective. But I think your second question is the one that drives more enthusiasm for us, and that is those Bonvoy members who also carry top of wallet, a Marriott branded credit card, disproportionately spend and concentrate their travel across our broad portfolio.
Anthony, if I have this right, you're working with OpenAI on something, a little bit of a TBD. Is it on the booking experience, and how do you see an OpenAI changing how I book a travel experience?
Yeah, it's AI. We could talk for hours. We look at AI as having the potential to impact our business in three pretty broad ways. I think at the property level, there's an opportunity to both enhance operating margins and create capacity for our associates to better engage our guests in a very personal way. In the above property level, there's a real opportunity to shift some manual processes to using technology to drive efficiency. And then the one that you talk about, Brian, is in maybe some way the most exciting, and that is how is artificial intelligence going to impact how travelers research and perhaps someday book travel. And so we are early stages partnering with leaders, with Google, with OpenAI, to try and figure out and ideally shape how we partner together to allow travelers that are accessing this technology to have access to the full breadth of our portfolio, rich content in terms of narrative descriptions of the properties, photo and video content, so they really can make informed decisions as they start to enter into the booking path.
Anthony, lastly, that's not an AI backdrop behind you. Where are you? We want to know where that beautiful bar is.
Yeah, we should be there.
Yeah, well, I am at the Pied Piper Bar at the beautiful Palace Hotel in San Francisco. This hotel was rebuilt after the San Francisco fire in the early 1900s. This is an iconic bar in the city and a perfect place to be after a 5 a.m. earnings call. So we're delighted to be here.
I hope there is a coffee in front of you off camera.
Or something
Anthony.
Stiffer. I mean, why not?
I
A little
don't know.
wine, Anthony. I know you're a wine guy.
If it's 10:50 here, it's really early in San Francisco for that. Yeah. Anthony, Brian, thank you so much. Appreciate it.
Thanks for having me.
Of course. Coming up, how do you dominate a market you're already the leader in? We'll look into Spotify and the state of music streaming next. Spotify shares are soaring after the streaming company reported record user numbers. It points to innovations like its Wrapped campaign and curated playlists as it hopes to continue dominating the streaming space. Let me bring in Jason Bazinet, media and entertainment senior analyst at Citi. He recently upgraded Spotify to a buy. Seems like the timing on that was pretty good there, Jason, considering that it's been sort of lagging this year and then saw a boost today. When Spotify has such a dominant market position, how as the leader does it not get complacent and like keep bringing in new users? What do you think is that sort of special sauce?
Well, I think there's sort of two vectors to your answer. The first one is in international markets, a lot of them have not gotten acclimated to actually paying for music. So I sort of think of Spotify as on a two-tier track. In Western Europe and the United States, adoption is quite robust. And the algorithm has really raised price by bringing more value to the platform. Outside all the other countries, think about continued subscriber growth as people get used to paying for music. More narrowly, how do they stay ahead of their competition? I think what we're seeing is sort of the very early stages of Spotify becoming, I think of it as a tailored sort of one-to-one audio experience, but not really interactive. Meaning the consumer can't really tailor exactly what they want on the platform. And as we move into agentic AI, I think that's the direction of travel for Spotify, is to make it even more customized, where you'll be able to just speak to your phone and say, play me my 5 favorite songs that I listened to last year, but not the same artist, but in the same genre, right? And AI will come up and offer something to you that will drive engagement.
Yeah, I mean, that's sort of akin to the new feature they have where you can kind of type in your description of kind of what playlist you want. So how is what they credited that, at least in part, with some of these subscriber gains or at least stickiness of subscribers. Yeah. Do you buy that? How big a deal do you think that is, and how successful do you think it is? Does it work real well yet?
Well, it's still early days. I think today you can type in, tomorrow you can speak into it. And then what's going to happen next is I think that they're going to turn all of their, I'll call them passive listeners, into content creators themselves, right? Which is what a lot of startups like Udio and Suno are doing. I can imagine a world where you can say, give me a country western song, that sounds like Jay-Z or something like that. And you begin to smash things together where you become almost a content creator yourself as opposed to a passive listener.
Well, and that speaks to there is AI-made music on the platform, but Spotify itself seems to be making that music. Hasn't there been a little bit of a backlash against that?
Well, there has. There's a couple layers to this. One, if you are a record label, you're very sensitive about what they call AI slop getting dumped onto the platform. And then when it comes time for Spotify to pay their royalties, if you're a record label, you don't want a slice of those royalties paid to the AI slop, right? So they're kicking the sort of AI slop off there to sort of protect their partners, which are the record labels. There's another vector of this, though, which is in an authorized way, could you actually allow one of your listeners to create music, right? And that's going to be sort of a new business model. You can imagine, you might pay $5 a month. You could create your own content. It would be authorized by the labels. A piece of that $5 presumably would go back to the labels. Spotify would keep a part of that $5 for allowing you to create music on the platform. That's where I think we're going.
In the meantime, it is very much humans who still dominate the charts on Spotify. And I was having a little fun this morning, Jason. I was looking at Polymarket odds of who would be the top Spotify artist this year. Like, it's kind of Bad Bunny, no contest. 61% is the bet that's being placed on that. Do you think that's the runaway winner? It's early in the year, but I don't know anybody else who's emerging to take that crown at this point. And how much is his success intertwined, or any artist's success intertwined with the success of the platform?
Yeah, I would say the beauty of a platform like this is you're sort of, you don't really care which artist is sort of at the top of the roster. The record labels clearly will care, but Spotify, I think, would be relatively agnostic whether it's Bad Bunny or someone else. They just are trying to drive overall engagement on the platform. And even if 5 years from now, most of the listening is sort of AI generated from consumers, I think Spotify would argue that's not a negative. It's a positive just because it keeps engagement up.
I don't know, I might argue it's a negative for humanity, but that's a whole other discussion that we could have, Jason. It's great to see you. Thanks for being with us.
Absolutely, thank you.
And by the way, if you want to look more at prediction markets, you can go check out Yahoo Finance Prediction Markets Hub, powered by Polymarket. That's it for Market Catalyst. I'm Julie Hyman. Thanks for watching. More Yahoo Finance coming up.